Hello and welcome to our discussion on accounting equation and financial statements. In this session, we will observe the effect of these business decisions on the financial statements. We already had converted these business decisions into the accounting equation. The accounting equation shows the impact of each decision on the sources and assets. However, cannot show directly how is this profit determined and why and how the cash is changing. For that, we would like to prepare and observe the financial statements. Let us hide these accounting equations so that we will not be affected by the accounting equation. The financial statements are the balance sheet, income statement and cash flow statement. Balance sheet is the financial position as on a date. Income statement is financial performance for a particular period, and cash flow statement is changes in the cash flows during a particular period. So we'll try to convert these decisions into financial statements, assuming that our accounting year is 1 year from 1st April to 31st March. So started business with cash, the firm is receiving cash, and that is capital, not an income. That is capital, and this entire capital will be shown as a source in the balance sheet, will be source in the balance sheet. Avail loan. Loan is also another source, so it is a receipt but not an income but a liability on the sources side of the balance sheet. Purchase stock of goods. For the time being, let us assume it for cash. So we make the payment for purchase or acquisition of stock. So acquisition of stock results in the outflow of cash or the cash payment, and the cash payment is 30,000. Purchase shares of the another company. This is also an acquisition of an asset in consideration of cash flow. So a share is an asset because it has the ability to generate the future cash flows. The stock which is available with us, we are now selling 60% of the stock for 50,000. So sales is 50,000, and let us assume that sales to be for cash. It is a cash sales, and due to the matching concept, we say that whenever there is a sale, there has to be cost of goods sold. In this case, the cost of goods sold is 30% of the stock which is existing, 60% of the stock which is existing. So, stock is 30,000 into 0.60. And the stock of goods sold will reduce the amount of the stock available. So, an asset reduces because asset has become an expense. Paid commission. A commission is an expense and a payment. So the payment is equal to 5% on the sales, 5% on sales, and we make the entire payment. So it is a payment and an expense. Whereas the next one, rent is due but not paid. But this has to be recorded because of the accrual concept. So the accrual concept says an expense, paid or not, should be recorded at the time of happening of the event. So if you see this, cash outflow, so cash outflow, the commission is an expense resulted in cash outflow, whereas the rent is an expense but resulted in creation of a liability. So expense paid is an outflow of cash, and expense not paid is a liability. Acquired C shares. So that means we acquired an asset, but not by paying cash, but by issuing shares. So my capital will increase to the extent of the capital will increase to the extent of the acquisition of the shares. No cash flow, but increase in capital. In the same manner, plant has been acquired, but not through cash, but creation of a liability called plant supplier. So sometime acquisition of asset results in outflow of cash, sometime it results in a liability, sometime it results in increase in capital. Then the dividend received is an income and also a cash inflow. So the entire dividend is shown in the cash flow statement as a receipt, and is shown as an income, the received dividend, because we have invested in a company, in the shares of the company. Interest is an obligation, so we have to pay the interest, but loan has been taken on 1st October, and we are assuming that accounting period to end on 31st March. So therefore interest will be for half year. So interest is an expense and outflow of cash. Since all transactions done, will determine the profit, and the profit is equal to incomes minus the expenses, so which is equal to 23,000, is equal to 23,000. But however, we'll assume here there is no tax, and we also assume that entire profit has been retained by the business. So therefore profit is transferred to the balance sheet, because we have not distributed the profit among the shareholder. Now we'll find the cash in hand. Cash in hand is equal to cash inflow minus the cash outflow, and that is 203,000 minus 122,000. So therefore cash is an asset, will be transferred to the balance sheet as the cash in hand. Cash in hand is 80,500. So two important items, the profit and the cash, are derived by preparing the income statement and cash flow statement. So now let us find the total sources will be equal to, should be equal to the total assets. So we can compare that with the accounting equation, and the accounting equation also shows the profit is same as the profit that we have derived here, that is 23,000, and cash in hand is 80,500. Cash in hand is equal to 80,500. So the process of measuring the business decisions and converting the business decisions into financial statements using the relevant accounting relationships is we call financial accounting. However, I would like to remind you and say that in this case, at this juncture, we are preparing the cash flow statement and in receipts minus payments method. But as we move along, we'll see the different ways of preparing the different cash flows. Thank you very much.